Hey everyone, welcome back to GavTax, where we help real estate investors like you make smarter tax decisions. Today, we are diving into a topic that a lot of people overlook: real estate accounting for passive investors. And trust me, just because you are not managing the property doesn't mean you can ignore the books. If you don't know what to track, what to deduct, or what the IRS is looking for, you could be missing out on thousands in tax savings. So, let's get into it. Let's start with the basics. What does it mean to be a passive investor? Simply put, you are investing your money into a property, but someone else is running the show. They are managing the tenants, handling repairs, and making strategic decisions. You might be part of a real estate syndication, a private equity fund, a limited partnership, or maybe you just pooled capital with friends or colleagues to buy a building. What you are not doing is being actively involved in the operations. You are not the property manager. You are not negotiating leases. You are not hiring contractors. Now, because you are hands-off in the day-to-day management, the IRS treats your role differently. You are classified as a passive participant under IRS rules, and that changes how your income is taxed, and more importantly, what kinds of deductions and losses you are allowed to claim. Unlike an active investor who can deduct certain real estate losses against other forms of income, like wages or business profits, passive investors are subject to more limits. The IRS puts guardrails in place to prevent people from using real estate as a blanket tax shelter without being materially involved. This means your deductions are generally limited to your passive income from other rental properties, partnerships, or investments where you also play a passive role. Now, that doesn't mean you lose those deductions entirely. They can often be carried forward to future years. But it does mean you need to be strategic with how you report and plan your investments. So even though you may not be involved in the operations, your tax position still depends heavily on smart accounting and proactive planning. Let's keep going. Why real estate accounting still matters? Some passive investors think, hey, I am not running the show. Why worry about accounting? But here's the deal. Real estate accounting still matters, and here is why. You are still earning income, even if it's passive, and that income must be reported. You are still receiving tax documents, like K-1s, that reflect depreciation, expenses, and gains. And you still have the opportunity to claim losses, offset income, and protect your cash flow, if the accounting is done right. Good accounting helps you understand your real return on investment, track your basis, which becomes critical when you sell. Avoid surprise tax bills from things like phantom income or depreciation recapture. So even if you are hands-off operationally, you should be hands-on financially. Let's talk about the most important document you will receive, the Schedule K-1. This is where your share of the property's income, expenses, deductions, and distributions is reported. But here is what many investors get wrong. The cash you receive is not always the same as your taxable income. You could receive $0 in distributions and still have $10,000 in taxable income. Or the reverse. Maybe you got paid $20,000 this year, but the K-1 shows a paper loss. That's why reading your K-1 properly and understanding what's real cash versus taxable gain is critical. If you are working with a CPA who doesn't know real estate, they might plug those numbers in without context and cost you big. Let's talk about one of the biggest tax benefits you get as a passive investor: depreciation. Even though you didn't buy the building yourself, the entity you invested in did, and that property can be depreciated. For commercial real estate, depreciation typically happens over 39 years. That means a portion of the building's cost is deducted each year, reducing the property's net income and therefore your taxable income. Here is the best part. Depreciation is non-cash, so you get a tax deduction without losing a dollar of cash flow. It's like a gift. And if the sponsor is using bonus depreciation or cost segregation, you could see paper losses for years, even while receiving strong cash distributions. It is one of the most powerful tools in the real estate tax playbook, and most passive investors don't even realize it's working in their favor. Now let's flip the coin. There is one thing that catches passive investors off guard: phantom income. This happens when the property is refinanced or sold, and your K-1 shows income even if you didn't receive any actual cash. Why? Because part of the debt was forgiven, or the partnership booked a gain, and your share of that income is taxable. Worse, If you have been taking depreciation for years, when the property is sold, the IRS will come back for depreciation recapture. That's taxed as ordinary income, not a capital gain. So even though you didn't touch the money yet, the tax bill still shows up. That's why planning matters. Knowing when these tax events might occur helps you prepare and protect your profits. Let's move on to another rule you need to know: passive activity loss limits. Here is how it works. If your investment has a net loss, let's say from depreciation or early-stage operating costs, you can't just deduct that loss against your W-2 salary or business income. Why? Because passive losses can only offset passive income. So if this is your only real estate investment and you have no other passive income, that loss is suspended, carried forward to future years when you do have passive gains or when you sell the property. It's not a total loss, but it does mean you need to think long-term. 5 actionable tips for passive investors. Let's wrap this up with 5 quick tips every passive investor should follow. 1. Keep all your K1s organized, even from deals you exited years ago. 2. Track your basis. Your tax basis determines what you owe when you sell or exit. 3. Understand your cash flow versus taxable income. Don't assume one equals the other. 4. Ask about depreciation strategy, especially if the deal uses bonus depreciation. 5. Work with a tax advisor who knows real estate. Not all CPAs are built for this. Passive doesn't mean careless. Passive means strategic. And with the right guidance, you can turn every deal into a tax-optimized machine. Thanks for watching. We hope this gave you a clear roadmap to real estate accounting as a passive investor. If you want help reading your K1, calculating your basis, or planning for a refinance or sale, book a strategy call at gavtax.com. See you in the next one.